In this video, I'll be talking about 3 trading strategies, which are bullish divergence, the supply and demand zones, and the bear flag pattern. So I'm going to try to break these strategies down as simple as I can, and I'll also show you an example of what each one looked like on the actual charts. So let's get started. So the first one is bullish divergence, and this is when indicators such as RSI or the MACD are going in a different direction than price. The second one is supply and demand zones, and these are areas of value where whenever the stock hits those zones, they will either be bought and sold in mass. So if you can look down here, whenever the stock price enters the supply zone, it starts to go down. And as it enters the demand zone, it starts to go up. So most of the time, when the price hits the supply zone, people start to sell in mass, bringing the entire price down. And normally when the stock price hits the demand zone, this area of value, people buy in mass, pushing the stock price back up, as you can see. And then lastly, we have the bear flag pattern, which is a series of candles that shape into an upside down flag. And whenever we see that pattern, we anticipate for the price to continue down. So it's a continuation pattern. And we'll get into that right now, actually. So right now we're looking at QQQ and we're looking at the daily chart. So what we're going to look at first is the bullish divergence. So like I said, when indicators such as RSI or MACD are going in a different direction than the price. So let's take a look at this. Okay, so this is your RSI and this is your MACD and this is your price. So here's a perfect example. Let me zoom in a little bit. Okay, so here's a perfect example. So we see that price is going lower and lower, like we hit lower lows, right? So we see that. And as you can see, my axis as I come down, hold on, let me get this. Okay, so you can see my axis as I come down, right, on the same price bar. This low of the RSI ends up going upward if we match it with this price bar as well. And then if we look at the MACD as well, we look at the MACD as well, the price ends up going up as well, right? So these two are going up and then price is going down. They're going into different directions. So this is an anomaly. This isn't normal. As you can see, if we look back into previous price action, look at my axis. So around this RSI and price, they're all in confluence. They're talking about the same thing. They're doing the same thing. It's all rising. And as it falls, you see that everything is falling. The RSI, the MACD, and price. It rises again, and then everything falls as well. So this is normal. For every cause, there's effect. For every action, there's a reaction. And this is the action. This is the reaction. These are lagging indicators. So price has to move in order for these indicators to record it and then show you the true movement. So when we get here, we see that they are going into 2 different directions. And this is a bullish divergence. So you can always tell we're always going to base it off of the direction that the indicators are showing. So the indicators are going up, like it's higher lows, and the price there are lower lows, that's bullish. We're always going to go with the indicators. If it goes up, bullish. And if it so happens to be a bearish divergence where price is going up and then the indicators are going down, then that means we're going to play puts. It's going to be a bearish move. And in order to enter on this trade, so first we would have to spot the divergence, which we already did. And then the way I like to do it, there's several ways that you can enter this trade, but I'm going to tell you how I enter the trade, is I look at the candles for confluence. So they all have to tell me the same thing. So you see right here, this is called a hammer. or a kangaroo tail. There's so many different ways to call it, but whenever you see a lower wick like this, a long lower wick, this represents buying pressure. So as the price moves up, we get our divergence, right? And I always enter on the pullback or the second touch. So meaning we see that we came up, price breaks the high. I'm sorry, this candle breaks the high of this candle. It comes back down. At this point, this is my pivot, this is my entry, and I will buy at the break of this candle. My stop loss will be the low of this. My entry is going to be above that pivot candle, and then my profit target is going to be the previous pivot high. And a pivot just shows you the change in trend. So if we look in previous price action, as we're going down, we see lower lows, lower lows, lower lows, lower lows, right? And then we get even lower, right? And then we come up high. So when it's high, low, high, that's a pivot, right? That's a pivot low. And then when we come back up, a pivot high is a low, high, low, right? And like even if you look here, this is not a pivot because we're going higher, 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 right? But this is a pivot because it's low, high, low. All right, so that represents a trend change, and we see that we're going down, right? So we see the divergence. It comes up a little bit. I wouldn't take that break of this candle. I will wait for it to come back and retest. So it comes down one more time. So this is a pivot low, a second pivot low right next to this one. This is perfect. I would place a call option above this pivot candle, place my stop loss below this pivot candle, and then my profit target will be the previous pivot high. After it hits the profit target, which it did, as you can see, I will place a trailing stop loss because now we're in no man's land. There's no profit target. There's nowhere we're going to go, right? So I will place a trailing stop loss, and I'll just keep riding the wave until my stop loss hit, and it'll take me out the trade. So that's the first strategy. The second strategy is supply and demand zones, which are areas of value where the stock is bought and sold en masse. So let's go to a lower time frame. See if I can find something. Give me 1 second. Okay, so I found it. There we go. Okay. So let me go ahead and make the supply and demand zone. So as I form the supply and demand zone, the way that you can tell which zones are which, there has to be a small body candle and then following a big push down. So this area is an area of value. We see this small little candle and then a huge push down, right? And then it retests, comes down for a continuation. So this right here, we're going to do the high of that small candle. Actually, let me zoom in some more so we can see it. Okay. So we're going to do the high of this candle. We're going to bring it all the way across here, and we're going to put it at the low of the body, or the closing price. It's going to be the bottom of the body. We're going to change this to red. Okay, boom. And then after that, what we're going to do is we're going to look for a demand zone, which will look for like a low. We're going to look we're going to look for a low point. We're going to try to look for like a small body and then a big push up, such as this. All right. And also, this can be considered too, because we got a small body and then we have a big push up. So we're going to do the most recent demand zone, the freshest one. So we're going to go to the lowest low, the complete opposite. We're going to do the lowest low, and then we're going to go to the top of the body. Boom. We're going to change this green for demand or for buy. Oops. Okay, boom. So as you can see, this is the supply zone, where this is an area of value, an area where, you know, most people would sell at. And then this is demand zone, and this is an area where most people would buy at. And these are pretty much areas or prices of the stock that people find attractive, right? So at this point right here, between $307 and $306, this is an attractive price. So as you can see, we pushed up, we came all the way up to around $300.11. This seems like an expensive price, so not too many people are going to buy here, and those who bought down here are going to sell at this point, right? At the highest point. We want to sell and get the highest profit we can, so we're going to try to sell at the highest price that we can sell at. So we push the stock price all the way up. It ended up getting rejected, right? It comes back up for a second touch. This is where we'll go short, or we'll end up selling our profits. If we bought in down here, we'll sell up here. Or if we didn't buy down here, we can play puts and go short on the second touch. So it hits the first one, then it comes back for the second one. This is perfect. I would enter at the bottom of this pivot high. As you can see, low, high, low. I will enter the bottom of this pivot high. My stop loss will either be the top of this pivot, it could be the top of the supply zone, or it can be the top of the highest high right here. So I will enter right here, place my stop loss right here, or right here, depending on your risk tolerance. And then I will ride the wave all the way back down to the demand zone, which it hit. And as you can see right here, we see this long lower wick. Zoom in for you. We see this long lower wick, which identifies buying pressure because we're in the demand zone. This is an attractive price, so they bought it up. It came up a little bit, it came back down, came up a little bit, tested it one more time, and then this was the close of the day, actually. So this is the supply and demand zone. So like I said, how I would enter is I'll wait for it to touch the zone, come back down, wait for a retest, right? A second touch, wait for that pivot to show me a trend change. So this is all confluence. So we hit the supply zone, then we hit a retest. That's the first confluence. The second one is a pivot high, which identifies a trend change. That's the second confluence. I will buy at the bottom of this candle of the pivot high, set the stop loss up here, and I will ride the wave all the way down to the demand zone, and I will exit as soon as it touches the demand zone. Or you can hit trailing stop loss because you don't know if it will breach the demand zone and go even lower. You can put it as trailing stop loss, however you want to do it. Okay. And then the last one is the bear flag pattern, when a series of candles shape in an upside down flag. All right. Let's see if we can find one. Okay, this is one right here. Like, the bear flag pattern is actually very, very common. They're literally everywhere. So this is our flag. That's our flag pole, sorry. So we had to have a flag pole. Then we come up. Okay, then we come all the way up. And then we see the break. We see the break right here of support. So this is support. This is resistance. It's shaped like a flag. And then it broke, came down, retested. I would have entered in at the low of this candle. This would have been my stop loss. This would have been my entry at the low of this pivot, low, high, low, pivot high. And then I would sell puts, or I would go short. I would buy puts and I'll go short. And I'll ride it all the way down till I see a reversal or hit the lowest low. So, well, actually, I'm sorry. It'll be the previous pivot low, right? So this will be the profit target. This will be the entry, all right? So as you can see, it's a continuation. This is a continuation pattern. So we went past the lowest, the previous pivot low, and that's the profit target. I would have set a trailing stop loss and let it ride all the way down until it hit a reversal. The trailing stop loss would have took us out by the time this green candle will form. We would have been in profit, and you can see there's an immediate reversal all the way up. So that's one bear flag. I guess technically this one could be two. but it's kind of sloppy. Oh, and one thing, you always want to have a tight consolidation. Like this is a consolidation, and you want to have a lot of candles. When there's a lot of candles and tight consolidation, that shows weakness. You see how we came all the way up from $310 all the way down to $305 in about 5 candles, right? So that's a $5 difference with 5 candles. And then we have 1, 2, 3, 4, 5, 6, 7, 8. We have 8 candles that barely made it past half of the move that these 5 candles made. It took way more candles. This is a sign of weakness. It broke and it continued to go down. So that's just a tip for you guys. And I think I have some examples. So I found this online. As you can see, this is a perfect example of the supply and demand zone. A lot of buying right here, like mass buying right here, hit supply, came down, pulled back a little bit. You could have entered, this is the pivot high, so low, high, low. You could have entered at the bottom of this pivot candle, set that as your stop loss right here. And then this would have been your profit target. And as you can see, it exceeded it. I would have set a trailing stop loss and it would have took me out before I hit this green candle. Or what you could have done, oh, and this is also a bear flag too. I wish I could like draw it, but this is the flagpole and this is the flag right here. It breached the low and it went down. So that's a bear flag in a supply and demand zone. So you could have played the bear flag, or you could have brought it all the way down to the demand zone and then exited on the demand zone. Could have bought at the demand zone. It went up, came back, retested. I would have bought at the break of this candle right here. This would have been my stop loss, and I would have rolled it all the way up to the supply zone. And as you can see, it does the same thing. Comes back down, retests, comes back down, retests one more time. It failed. So it came in here. It failed 1, 2, 3 times. That's a lot of, and it's going lower and lower every single time. So I definitely would have played calls right here. Set this as my stop loss. If you wanted to be safe, this could have been your profit target. You could have got out right here, or you could play it all the way down to the demand zone. Second one, this is the divergence I was talking about. So as you can see, this is a higher high, and then this is a lower low. It gets one more push up, and this is a bearish divergence. This isn't a bullish one. So it gets one more push up, and then it comes crashing all the way down. So at this point, like I said, this is what we would identify our divergence right here. It went up, came back down. Since we're expecting a trend change to the downside, this pivot low, you know, high, low, high. This would have been my stop loss. Oh, I'm sorry. So I would have waited for the uptrend. So I would have came up right here, came down, came up right here. This pivot high right here, low, high, low. This would have been my stop loss. I would have took it at this break of this candle right here, and then I would have rolled it all the way down. And at this point, you could have set a trailing stop loss. Well, this would have been your profit target right here. After it hits your profit target, which exceeded, you would have set your stop loss immediately after you hit, and then it would have took you out like around right here. All right, and then here is the bearish flag. So we got a strong downtrend, right? That shows, that identifies the trend of the market at the time. So here's the flagpole, and then you see this tight consolidation with all of these candles. This is easily twice as many candles as right here, or nearly twice. And then we got the break right here. This would have been a stop loss up here, the pivot high, which is low, high, low. So it could have been this, or it could have been the top of the resistance line, either or. They're right next to each other. At this break, you could have went ahead and take puts, but I prefer to wait for the first pullback, which is right here, which is this pivot, low, high, low. I would have waited till it broke right here. And then this would have been my profit target. The low was low, the previous pivot low down here. As it exceeded, because this is a continuation pattern, and I would have set a trailing stop loss, because now we're in no man's land. There's no target nowhere, so we'll just set a trailing stop loss and ride that wave all the way down until the stop takes us out. Okay, so So for this video, let's go over the entries and exits. Sorry. So the entry for the bullish divergence is break above the second pivot low candle. The profit target is going to be the previous pivot high candle, and then the stop loss is going to be the low of the pivot low candle. So, supply and demand zone, we're going to do the second touch or the retest of the zone. So we can see down here, we came down. People found interest in this price. It came up, came back down. That's the retest, the second touch. I would have played calls, set the stop loss at the bottom of the zone or the bottom of this pivot low right here, and rode it all the way up to the supply zone. And I would have did the same thing, came down, retested, set the stop loss right here, and rode it all the way down to the demand zone. So the profit target is the opposing zone, and the stop loss is the bottom of the entered zone, or it could be the bottom of the pivot if you have a low risk a low tolerance for risk. Then we have the bear flag pattern. The entry would be the break of support or enter on the first pullback. I prefer to enter on the first pullback personally, because nothing is guaranteed in the market. You know, it can possibly, a bear flag is just a high probability setup, but it's not 100% guaranteed. So I will wait for the first pullback, enter, and then I will ride the wave all the way down. And normally the movement after the first pullback is always the biggest one normally. The profit target is the previous pivot low. It's the previous pivot low, and then the stop loss is the top of the flag or the previous pivot high. So it'll be the top of the flag or the previous pivot high. And then we have our day trader loss for this video, which are key points and good to know whenever you're trading. So the first one is place a stop at your entry price. So on momentum or continuation trades, the trade should go in your favor almost immediately. Place a stop at your entry price just in case. So just in case somehow, because you know the market can act irrational, we can't control it. So whenever you enter a trade, it should almost, especially momentum or continuation trade, it should go in your favor almost immediately, especially if you enter on a retest or a pullback. So set your stop loss either at your price target or at the pivot low, the respective pivot of the direction you're going in. It all depends on your tolerance of risk. The second one is place a trailing stop loss. So after the profit target hit, we're in no man's land, meaning there's no other target. We don't know when it's going to reverse. We have nothing to help us out. So place a trailing stop loss. Me personally, I normally do 5 to 7%, and I let it ride out until it reverses. To me, I do 5 to 7%, but I'm a scalper. So if it goes back 5 to 7%, normally that does entail of a reversal, because that's kind of like a steep pullback, or that's kind of like it's like a steep pullback that'll possibly turn into a reversal. Number 3, respect your stop loss. So your stop loss is not a random price. Each pivot that we set the stop loss, or the top of the zone that we set our stop loss, that's not a random price area or a random area of value. That's where support is, right? It's the support of the trend. And once that support breaks, we're in the opposite trend than we expected, and we need to get out and possibly even, go ahead and cut your losses and then play the reversal. So you can still somewhat profit when it comes to placing your stop loss, as long as you place it correctly in the correct spot. So that's about it for this video. I hope I made it simple enough for you guys to understand. If you have any questions, comments, or concerns, leave it in the comment section. I'll be sure to look at it and I'll get back to you. And if this video helped you out and you enjoyed it, don't forget to hit the like button, subscribe to my channel, and hit the bell to be notified when I make more videos. Y'all be easy.